Welcome back. A hearing took place in an Ontario court today in Brampton, Ontario, in the case of former Magna International Chief Executive Officer Frank Stronach. He is facing 13 charges of sexual assault. Those charges relate to alleged incidents that date back as far as 1977 and as recently as this year. Stronach's lawyer, Brian Greenspan, says his client denies the allegations and will vigorously defend them. CTV's John Woodward is tracking this story, and he joins us now. John, thanks a lot for joining us. I know you're going to be limited in what you can tell us because of publication bans, which are very common, almost universal at this stage of a criminal proceeding in this country. But tell us what did happen this morning, and was Frank Stronach in that Brampton courtroom?
No, Frank Stronach was not in the Brampton courtroom. He was not required to be there in person. His lawyer showed up virtually, but he did, I suppose, disappoint at least a dozen members of the media who were here waiting for him to arrive. But you are correct. This is early days in the legal system for Mr. Stronach, the 91-year-old billionaire and founder of Magna International. The first appearance here mainly consisted of the judge asking his lawyer, Christopher Lutz, some questions about legal matters, passing emails with designations back and forward, and wrangling for the court's purposes the charges, 13 of them in total, that have come from the Peel Regional Police. They come in two batches, the first 5 and then 8. The charges dating from as far back as the 70s to February of this year. And many of them are sexual assault, some of them are forcible confinement. And because the legal system is dealing with allegations that go back decades, you can see how the legal system's handling of charges like this changes as well in the names of the charges. So I'll give you one example. The earliest one from June 5th, 77 to January 31st, 1978, at some point in that date window, is an attempt to have sexual intercourse with a person who is not his wife without her consent. So the legal system has to deal with the law as it was at the time, which is going to make maybe be a wrinkle for this court handling these 13 charges as they go forward. Now, I should say that otherwise, Stronach has a no contact order with any of the complainants, and we did hear some details about the types of disclosure that the defense lawyers are going to be expecting from the Crown. But as I said earlier, as you said earlier, the judge has put in a publication ban. So I'm afraid I can't tell you about that, but I can tell you a statement from Mr. Stronach that we got recently. Mr. Stronach denies and will vigorously defend these further untested allegations going back to 1977. He has spent his lifetime committed to the betterment of the Canadian community and industry. He plans to continue to devote his energy and resources to his work advocating for the adoption of a Canadian Economic Charter of Rights to benefit workers, small businesses, family farmers, and the Canadian economy. That's from Stronach's lawyer, Brian Greenspan, who intends to fight these vigorously. Stronach's next court appearance is October 7th.
Was Brian Greenspan in the court today? I heard you mention the name of another lawyer from today's proceedings. I believe that was Christopher Lutz, who's an associate at Greenspan's firm.
Yeah, you are correct. Greenspan himself was not there, but his associate Christopher Lutz was handling the proceedings. Again, mainly, we're such an early stage here. We haven't dealt with evidence. We don't have any witnesses. The normal things that people expect from a criminal court proceeding, that's to come. And there are probably going to be several court appearances going down the line as the defense and the Crown wrangle over disclosure. There may be some applications to limit evidence, or voir dires, as they're known. And but we do expect that this will proceed under the normal course, whether, in Canada you are entitled to the same protections, and whether you're an average citizen or a 91-year-old billionaire.
Okay, very quickly, the next date on this file is what?
It's October 7th, 9 a.m. here at the Brampton Courthouse.
NASDAQ and the S&P 500 both at or near fresh all-time highs today. We could get a 35th record high for the S&P 500 this year, just in calendar 2024. Our guest says there are reasons to be cautious about these markets. We're joined by David Deets, Managing Principal at PPAC Private Wealth. David, thanks very much for coming on. You think there's too much optimism, even euphoria out there right now?
Well, certainly that euphoria and optimism is really just concentrated in those global mega cap tech stocks, which are now trading at about 10 times, not earnings, Andy, 10 times sales. We've never seen a multiple like that, even going back to the dot-com days in the late 1990s. On a price to sales basis, stocks were never that expensive. We're seeing all the cash flow just move into that narrow area of the market. You've got the momentum investors chasing these stocks. You've got the passive index investors thinking they're widely diversified by buying the S&P 500, but up to 30 to 35% of their money is moving into those few names. And of course, everything is getting sucked out of the rest of the market.
We are kicking off U.S. earnings season. We're expecting Pepsi and Delta on Wednesday. Broadly, what are you expecting from the non-tech sector?
Yeah, absolutely. So I think overall we're going to be seeing about 8% year over year. I think the bar is very low relative to last year's earnings, so it's going to be a better earnings season than last year. But you're right, Andy. If you strip out the earnings results expected from those top 10 stocks, is certainly a more muted year over year gain that we're going to see. So, for example, all eyes really are going to be on the financials. They're going to kick things off on Friday. We love the financials because not only do they tell the story about what they're doing, but they also give you a good read through to the economy. Now, unfortunately, we're only looking for really a 4% year over year earnings gain. It's going to be very interesting because you do have some stocks that have done quite well. JP Morgan, of course, at all-time highs right now. Citigroup and Wells Fargo have also done extremely well. Can the earnings they report justify their recent nice runs?
We did get the U.S. jobs data on Friday. It was mixed. I mean, it was some decent job creation, I know. Does the market need Fed rate cuts to go higher, David, do you think?
Well, certainly it would be helpful. Anything to bring down the pressure on these key industries which are really struggling here. So, for example, we talk about inflation, but if you look at commercial real estate, Andy, and I'm not just talking the office sector, I'm talking about everything that's non-residential. That's down 22% since March 2022, and that's affecting all sorts of real estate funds, investors, banks, and so forth. So certainly reducing interest rates would help. The problem may be that really nothing is broken right now. You've still got unemployment still pretty strong. It did tick up a bit to 4.1%, but the job creation was decent, better than expected, over 200,000 in terms of June. So I think could be a situation where the Fed says, let's just sit on our hands here and see what develops. The problem, of course, is that monetary policy acts with a lag, and many of the indicators they're looking at are backward looking. And by the time, if things start to go downhill, they could go downhill very fast, and it might be a little late for Fed rate hikes to stop that.
The presidential election, obviously, is a wild card. Investors apparently had been positioning for a win by former President Donald Trump. What do you think a Republican sweep could mean?
Yeah, so I think the party line, of course, is a sweep by either party could be detrimental to the financial markets. Now, why would that be? Because, Wall Street likes the way things are. They kind of like gridlock. They don't want any big movement in any one direction, particularly perhaps excessive spending that creates more of a budget deficit situation. So the initial concern was after the debate that there could be a red sweep, former President Trump taking the presidency and then the Congress being dominated by the Republicans, and then perhaps that would include tax cuts, which would not be supported by spending cuts, and of course perhaps tariffs that really restrain trade and echo what we saw in the 1930s with Smoot-Hawley and so forth. And so we saw these bond yields starting to move up. At this point, I think it's really too early to tell. We certainly tell investors, don't invest with your political views in mind. It's very, very tricky, and we're going to perhaps know a little bit more in the next 30 days as to who Mr. Trump may be facing.
You have some stock ideas for us, starting with Exxon. Why would that be one of your energy favorites, David?
Yeah, absolutely. So first of all, the whole energy sector is really the antidote to technology. When you look at correlations, they're almost perfectly negatively correlated. So if you agree with me that some chips should come off the global mega cap table, energy would be a great spot there. Of course, we've got two mega cap energies here. We've got Chevron and Exxon. They're both trading extremely cheaply, with Exxon trading at just 11 times next year's earnings, a dividend aristocrat. So you've got that nice close to 4% dividend, but they've increased that dividend for more than 25 years in a row. They're involved in all phases of energy production, both in this country and overseas. And so you've got that broad diversification. And certainly when you look around the world as to the issues we have to face, geopolitical disturbances, potential resurgence of inflation, volatile economies, energy is often the antidote there. So buy Exxon now, it's about 11% from its recent 52-week high.
And then just one other idea here, Pfizer, they don't have the buzz over these weight loss drugs, but you see promise?
Yeah, absolutely. And you know, all they need to, I think they ultimately will be able to play in that space. And I just ask people to look at Pfizer versus Lilly. They both have about the same number of revenues, right? Mm-hmm. But Pfizer is trading at nearly 7 times the market cap of Pfizer. So we ultimately think the company that brought us the vaccine, that kind of helped save the world from the global pandemic, will ultimately come up with some sort of a weight loss remedy there, and that could close that margin between Lilly's market cap and Pfizer's.
Well, for more on individual stock movers in the United States, we're joined by Emily Grafeo. She's cross-asset reporter with Bloomberg News, and she joins us with more from New York. Emily, let's begin with Intel. What are we seeing there?
Well, there's a lot of movement in this stock this morning. It's pairing gains. It was set to extend its 5th consecutive session of gains. That would have been the longest winning streak since January. But now we're seeing a little bit of weakness, and perhaps this speaks to the broader story for a number of these chip stocks in the market. They just can't keep going up all the time. And actually, it's been interesting to watch Intel here, because although it seemed like a broader chip stock rally, moves in NVIDIA were helping power Intel up in the last few days. That hasn't been the story for most of the year. You look at the year-to-date performance of Intel, it's down over 30%, and you compare that to NVIDIA, which is up almost 170% year-to-date. It hasn't, again, Intel hasn't really been able to capture that AI frenzy in the market right now. Jordan Klein of Mizuho Securities said there's not exactly a clear catalyst to the downside for Intel in the immediate term, but long term, he says, long only investors, he doesn't think they want to buy Intel, so it's unclear whether the stock can truly rebound above the mid $30 range that the stock is in about right now.
Chewy is under pressure. What's going on there?
That stock is down over 2% right now after an analyst downgrade from Argus Research. This is from analyst Christina Ruggeri, and she downgraded the stock to a hold from a buy, citing continued declines in the pet company's active consumer list amid weaker economic conditions. Chewy is also expanding into Canada, and the analyst said that there'll be substantial investment spending as Chewy pursues that expansion, and that could weigh on the stock's upside. And she noted that valuations look a little shaky here. The stock is trading at a premium to its peer group based on price, sales, and EV sales metrics. That stock is down 30% over the last year, Paul.
And why don't we finish with Nikola?
Okay, this is another stock that has been moving around all morning because it was up as much as 10% in the pre-market. Now it's down about 4%. What was happening earlier was that it seemed like investors were they were buying up this company because the truck maker reported wholesaling 72 of its Class 8 hydrogen fuel cell trucks through the second quarter. And actually through Monday's close, the stock had rallied about 42% over the last 4 sessions. We're seeing now those gains reverse. And to be sure, when you look at the stock on a longer term basis, it's down more than 99% from its record high seen in 2020, and it's fallen 60% this year. So perhaps investors getting a little excited. You can see on that chart the big spike up and now taking some profits.
Many investors are worried about high valuations and even a potential stock market bubble. with American and Canadian markets trading at or near all-time highs. But our guest says we are not in a repeat of the 1999-2000 tech bubble or the 2021 euphoria over tech stocks. He says markets in the US and Canada are showing healthy skepticism. Ernest Wong is head of research at Baskin Wealth Management. Great to see you.
Yeah, good to see you.
For example, compared to the turn of the century, you say there were companies that had no real prospect of profits, whereas a lot of these tech giants these days are making plenty of money.
That's right. I think given the sharp run-up, especially in the S&P 500 over the last 12 months, I think it's very natural that investors are asking whether we're in for a repeat of what happened in 1999 or in 2021, when tech stocks went to the moon and then crashed back down. But I think there are some important differences that investors need to keep in mind. The first is that in both of those periods, monetary policy was trending higher in those cases. Today, I think it's more likely to say that monetary policy is likely to go lower. More importantly is that you just don't see the same level of euphoria out there in the market today. In 1999 and 2021, you were seeing unprofitable businesses that really have questionable business models go public, get 10 to 20% stock market pops simply for being loosely related to the internet or electric vehicles or cryptocurrencies. That's not what's happening today. IPO level overall has been fairly muted over the last 3 years.
In the States as well?
In the States as well.
Okay.
And I think what you're actually seeing is that the market is being quite selective in terms of who it's rewarding with a high valuation. Certainly, there's companies in the semiconductor industry that have really performed really well, but then this is not broad-based. If you look at companies like Tesla or Adobe, these are companies that are participating heavily in artificial intelligence, but they are flat to down year to date. So I think that's what you would want to see in a healthy market, in that the market is appropriately trying to decide what is a winner and what is not.
It is interesting, the dearth of IPOs. It looks like private equity is financing more and more businesses.
Yes, and I think that it's partly a function of the dry powder that we've seen in private equity build up. They have to find a place to deploy it, and so I think many companies are finding that that's a more attractive way of exiting rather than going into the public markets.
Yeah. Jason Burko just had a great story in the Globe about this, and he says the governance hassle is one reason companies don't want to go public. You have people looking over your shoulder all the time.
Yes, and especially the regulatory and the compliance burdens that exist with being a public company. I think many companies are seeing that and deciding, well, why don't I just stay private?
Yeah, you can. And it's not necessarily, I think, that they're trying to pull tricks or anything. It's just the amount of red tape. So that's interesting, the global IPO activity down. That, as you say, it doesn't point to investor euphoria.
So I think it's really anyone's guess as to what stocks are going to do over the short run. But I think this is really a stock picker's market. What I mean by that is that if you're able to find a company, like let's say you're skeptical about artificial intelligence, think it's overhyped. There are still plenty of companies trading at reasonable valuations where the stock is going to be the stock performance is going to be determined by the fundamentals of the business rather than just broad market swings.
You have some ideas for us, starting with an outfit called CoStar. They provide analytics for commercial real estate. You see promise there. But isn't commercial real estate in trouble?
Yeah, so CoStar is a leading provider of analytics for the commercial real estate industry. They provide comp data and market data sets to brokers for all sorts of commercial real estate in the US. Shares have been under pressure partly because of their exposure to commercial real estate, but more because they've been on a very extremely aggressive investment cycle into homes.com, which is kind of a portal that they're building for the residential market for you to buy and sell homes on. I think the market is skeptical that this investment is going to pay off, but we think that if you look at the track record of what CoStar and the management team have done, especially with other initiatives that they've done in the past, we think there's a good chance of success.
Adobe, you mentioned that, and Adobe shares are down about 5% this year. You think the market's being too hard on them?
So Adobe is interesting in that the market seems not to have been able to figure out whether it's going to benefit from AI or be disrupted by AI. Mm-hmm. We think there's a good chance that it will end up being a winner. And the reason for that is because if you look at the history of technological innovations, mm-hmm. they've mostly led to more content being produced. And we think that's going to happen with artificial intelligence. Most of this content is going to have to be edited by Photoshop or Illustrator or all of Adobe's tools. They're the only ones that have the distribution and the scale to be able to manage all of this content. And we think that shares will end up reflecting that.
And then finally, restaurant brands. I see actually Bloomberg reports today that in restaurant stocks, a lot of them are down lately. But you see restaurant brands as holding promise.
Yeah, so restaurant brands the stock has been impacted by the same issues facing most of the restaurant industry. But if you look at the actual fundamentals of the business, traffic has actually outperformed most of its peers across all of its brands. And they've made a lot of moves, for example, through the remodeling of Burger King, through things that they're doing in digital and Tim Hortons to reposition the business for growth. And we think shares are attractive, trading at a discount to the sector.
Welcome back. Taiwan Semiconductor's second quarter sales grew at the fastest pace since 2022, driven by artificial intelligence spending. Bloomberg Intelligence believes Taiwan Semi is poised to outpace its peers in the coming chip manufacturing cycle. For more, let's bring in Charles Shum. He's technology analyst at Bloomberg Intelligence. Charles, thanks a lot for joining us. Tell us more about these Taiwan Semi numbers.
Hi. Thanks for bringing me in today. About just the TSMC's result we have seen this morning, I think this is unusually strong. The 40% year-over-year growth actually that brings to a sales number that exceeds its top end of its second quarter guidance. Actually, this is a normal for the second quarter because this is usually a low season for the semiconductor manufacturing. So I think that the only possible explanation for such a strong performance is that there's a very robust demand for the AI chips, not just from NVIDIA, but also from the others. And also there's another strong demand for the TSMC's advanced packaging, CoWoS packaging. That's the only advanced packaging that is most the chip makers now relying on to produce today's AI chips.
And one result of this very, very strong demand for AI chips is that companies like Taiwan Semi are able to raise their chip prices, correct?
I think this is actually is likely happen in the if not in the coming 6 months, but would be very likely to happen in the 2025. Actually, that's actually one of the focus that we should pay attention to in the coming earnings call. Actually, I think given that as a strong demand, not just for TSMC's advanced nodes, such as the 3 nanometer and also 5 nanometer, but also its advanced packaging, I think the TSMC has very great power now to actually ask for a price hike for the coming 6 months or 2025.
And are we seeing that at other chip makers as well, that same dynamic?
I beg your pardon?
Are we seeing other chip makers being able to raise their chip prices on the back of strong demand?
Unfortunately, I think that this is only the benefit that TSMC will enjoy at this point, because right now the strong semiconductor demand actually is mostly focusing on the AI chip that will largely depending on TSMC's advanced node to manufacture. For the other chip makers, they are more focusing on the consumer electronics and also EV chips. Actually, they don't have that luxury to raise the price, because we are still seeing that the capacity is very sufficient to meet the demand. actually another reason to consider is about China, because China, we are seeing that it is very aggressively expanding its capacity in the mature node, and this capacity will be largely used to produce those consumer electronic semiconductors I just mentioned. So there's not much room for the other chip makers to raise their price at this point.